Uh, Hi everyone. Here is Wenze. Today I'm going to walk you through a topic that I think is very rele is I think is very relevant, both historically and right now in 2025. And it's about whether the Federal Reserve's 2020's policy framework actually slowed down its response to the big inflation spike that followed COVID. And more importantly, I will talk about why that will matters and how I think what monetary policy today. So I choose this topic because it helps us understand how theory and practice in monetary policy can diverge, especially when central banks face uncertainty and conflict goals. Uh, so let's say let's start with that the Fed change in 2020. After years of really low inflation and interest rate stock near zero, in August 2020, the Fed rolled out something called flexible average inflation targeting. You will often hear it called FAIT. The basic idea was instead of treating 2% inflation as a ceiling, the Fed says it's okay to go above 2% for a while, especially if we have been below it for a long time. And at the same time, they shift focus more strongly toward achieving maximized employment, including making that growth more inclusive, meaning paying more attention to outcomes for monetary and low-income workers. And finally, they move away from acting based on forecast, like expect inflation, and said they have wait for actual data before changing policy. So here is the tricky things. Oh, here is the tricky things. Slowly after the new framework was stopped, inflation began to rise sharply, and inflation starts rising in early 2021. By March, it had already crossed 2%. And by June 2022, we were looking at over 7%. But the Fed didn't raise funds rate until March 2022. So why the delay? This long pause has raised this question. Did the new framework itself contribute to delayed response? Romer argued yes. They showed that the Fed's own forward guidance in 2020 states that both goals 2% inflation and maximum employment must be made before rate hikes. This effectively created a double hurdle. Especially, the Fed had redefined the maximized employment more aggressively. So, uh, even as price rose fast, they didn't feel ready to act. And as a result, policymakers waited for labor market to become extremely tight before acting on inflation, even when prices were already surging. So the Fed's dilemma. This already highlights the tension in the Fed's dual mandate, stable price and maximum employment. Normally, the two goals don't clash too much, but in practice, in this case, these goals can conflict, especially when inflation rates during period of economic recovery. Trying to fully recover the labor market means delaying action on inflation. By making the employment mandate more inclusive and asymmetric, the 2020 framework effectively prioritized jobs over price stability in the short run. This was especially evident in 2021 when officials emphasized the need to see actual improvement in employment, particularly for disadvantaged groups before tightening policy. From a policy science perspective, this raises an important question. Should the central bank be more rules based on more discretionary? The Fed's news approach leaned towards discretion, waiting for data, no forecast. But as Evans notes, this delayed response may reflect how slowly the Fed inflated practical exclusion features more than practical flaws. Okay, that is what I say. Okay. Fast forward to now 2025. In 2025, we are no longer in this crisis, but inflation remains a concern. Although inflation has declined from its peaks, uncertainty persists about whether new supply side shocks like geopolitical tensions and climate shocks keep popping up may regenerate inflationary pressure. Meanwhile, the labor market maintains resilient and strong. So the core dilemma remains that the same question: should the Fed act early or wait for proof? And should they prioritize the fighting inflation or support employment as long as possible? And how much should it rely on observed data versus forward-looking modes? This is especially important because these are not theoretical questions. With a potential fast framework review scheduled this year, the lessons of 2020 to 2022 period are influencing discussion in the real time. Should the Fed revise the framework again to better handle supervised inflation or remain its commitment to inclusive employment goals and even at the cost of price stability in the short run? So what we have learned uh, what can we take away from all this? First, we will design a policy framework can be unintended consequence and go sideways if too rigid or too slow to adapt and implement inflexibility. And second, when framework tie policymakers' hands too tightly, having to meet multiple conditions, like requiring inflation criteria and full employment, so can slow down decision making and reduce responsiveness to fast changing conditions. And third, central banks need to be clear about how they make trade-offs, especially they may be transparent not just in goals, but even more importantly, between crises. In short, this debate isn't over, it's evolving. As a student and future finance analyst, I understand these contents help us make smarter about policy decision ahead. And in conclusion, the 2020 framework was a broad shift in how the Fed thinks about inflation and employment. But the past pandemic experience shows that anchoring policy too rigid to achieve goals can introduce new risks. As we faced continuous uncertainty in 2025 or in the future, the framework debate is far from over. Thank you for hearing.